All right, changes in accounting principle. We'll start with that. So again, changing from one accepted accounting policy to another. So changing between inventory valuation methods or completed contract or percentage of completion when we're doing construction projects. So what are not considered changes? Adopting a completely new principle or adopting a principle for a previously immaterial event. This is something new, right? Not a change from something existing to another thing that's existing. This is completely new. These are examples, just elaborated on further. And there are three approaches for reporting changes. We've got current changes, so meaning, all right, you see the change, just change it now in the financials. Retrospectively means you go back and restate all of your prior financials. And you've got prospectively, meaning all the financial statements in the future will change and use this new accounting principle. FASB requires the use of the retrospective approach, meaning when you have a change in the accounting principle, you have to go back and restate all of your prior financial statements, which sounds like a lot, and it is. It definitely is. So just a lot of work to have done there. Now, this retrospective change in accounting principle, the company that reports the accounting change must make an offsetting adjustment to the opening balance of retained earnings as of the beginning of the first present year. So we got to go back and adjust retained earnings. We have to adjust the carrying amounts of assets and liabilities as of the beginning of the first year presented, plus the opening balance of retained earnings. And lastly, we need to adjust the financial statements for each prior period presented to the same basis of the new accounting principle comparability. All of these are saying is that we want to compare apples to apples, oranges to oranges, right? We don't want to have financial statements in 2019, 2018, 2017 that are all in completely different principles, different methods, and we can't compare them with each other because that just they're different. It wouldn't be helpful at all. So this is for the benefit of the investors and the creditors, the users of the financial statements. All right, how about reporting a change in accounting principle? So in addition to making changes in the financial statements, so changes in numbers, right? Changes in the estimates, changes in the numbers, there are requirements to disclose the changes in the notes of the financial statements, which you should remember from that section. It's talked about there as well. This is the executive summary. This is where you go on to elaborate and describe further some important items. So you need to disclose the nature of the change in accounting principle, pretty straightforward. Also, the method of applying the change. So how did you actually make the change? Well, describe or make a description of the prior period information that was adjusted. So if you went back and adjusted retained earnings, talk about that. Describe it. Talk about it. Use your words. Use your feelings, right? Effect of the change on income from continuing operations, net income, or other affected line items. Again, talk about it. If you change net income, you need to mention it because maybe someone's using the old version of the 2017 financials. Mention that you made a change so they know to use the updated version from now on. Cumulative effect of change on retained earnings or other components of equity or net assets. Remember, equity and net assets are the same thing. They're interchangeable because assets minus liabilities equals equity. Same thing there. In the balance sheet as of the beginning of the earliest period presented.